Hi guys, a very good morning to all of y'all. Hopefully my screen is visible. Right. So today what I have planned is simply to do December 2021 past paper, which was Chuckle, right? Which was Chuckle. So that would be our plan, right? And I'll make sure that I'll try my level best to pitch it in a way that y'all are able to understand it. Okay. So when y'all look at this requirement, right? Some might be bored, some might be scared, right? And some might be positive over that, right? So what I would ask from y'all is don't be worried at all, right? Y'all are able to attempt this, even though this might be looking like Greek, right? It has lot of requirements, right? Examiner is been testing y'all with multiple standards. Y'all don't need to worry at all, right? Y'all don't need to worry at all, right? When y'all start attempting this personally by yourselves, right? You all will be able to understand this was an easy question that I was fussing about, right? So you all don't need to worry. Even though the question looks ugly, right? The question looks ugly because it has multiple requirements, right? This is a question that y'all are easily able to attempt, right? So let us start doing on the question and y'all will understand how much this is easy enough, right? And how y'all could score majority of the marks compared to other questions. Okay. So be positive. Make sure you all have your cup of water right next to you. And for the people who are sipping coffees, make sure you all have another coffee right next to you. Okay. So let as usual, I would go obviously and go and read out the background to identify the financial year, which would be your 1st April 2006. Right. Then I would, as my usual pattern, would go and read off the requirement, right? What does the examiner wants me to do? That's the question that I would ask for myself, right? He wants me to use exhibit 1. He wants me to use exhibit 1, right? And he wants me to show whether that particular investment, right? They have gone and invested in a company known as Greenco, right? Whether that is an associate or a subsidiary, right? He's examiner's puzzle whether do I need to go and categorize it under associate or subsidiary. This is being tested for 4 marks. This is simply your requirement test. This is simply your requirement. Where do I go and put it? Do I show it under associate? Do I show it under subsidiary? Right? For a 4 mark. I'll give you all a pattern. I'll give you all a blueprint of how do you all answer this. I'll give you all a blueprint of how do you all answer this. Right? Give me a minute. Give me a minute. Right? If you all need to grab in the 4 mark, guys, if you all need to grab in the 4 mark, what you all simply need to do is, examiner wants us to speak or he wants to show where do we classify, right? He itself has given us two options. Either it's an associate or either it's a subsidiary. So make sure you all go and give the definition, right? Make sure you go and give the definition of the associate and subsidiary, right? This should make sure that you all grab 2 marks, right? This should make sure that you all grab 2 marks. And what is remaining? What is remaining? We only have another 2 marks to score. Okay. We will have another 2 marks to score, and 1 mark would automatically be given for the conclusion, right? For the conclusion where you state this is an associate or this is a subsidiary, that is 1 mark. So already you all have 3 marks in hand, right? And finally, you all are left out with you all need to relate, right? You all need to relate it to the paragraphs, right? You all need to prove. If you all are coming up with a conclusion, you all need to act like a lawyer, right? You all need to act like a lawyer, a professional lawyer, right? He would not just rest his case. He would give us proofs. He would give us evidences like that. You all need to make sure that you all are able to justify your answer, and you all be able to get that 4 mark, right? It's quite simple as that. I have given you all the blueprint, and going forward, I'll make sure that I'll give blueprints such as this, right? So now I'm going to read your very first requirements exhibit, right? Your very first requirements exhibit, and I'll only be reading the important paragraphs, right? I don't want to, waste my time as well as yours. Okay. So let me take off my highlighter. on 1st April 2004, right? This would be your, uh, this would be 2 years before your current financial period. 2 years before your current financial period, because your current financial period is 2006, right? You all have bought 30%. Okay. Obviously, when you are looking into this 30% voting rights, it would click into your heads. It is either an associate or joint venture. It is either an associate or joint venture. But since the examiner has clearly mentioned it is an associate, you all need to use IAS 28. You all need to use a standard known as IAS 28, which is always used for investment in associate, investment in joint venture, right? This is all you all need to know. Okay. You all have gone and invested in Greenco. How much did you all invest? You all invested 100 million of cash, right? 100 million of cash. You all gave in 100 million cash. You all got in back 30% of equity interest, right? Simple as that. Simple as that. Okay. Obviously, I would like to say, guys, when you all are going and investing a large sum, right? You all have gone and invested 100 million of cash. When you all are going and investing 100 million of cash, guys, you all will not only get voting rights, right? You all get something known as assets also, right? You all will be going and getting some assets as well, right? Obviously, that companies would have assets as well as liabilities, right? Now, out of that, 30% of those assets would be yours, right? Simple. 30% of those assets would be yours. How much is the assets value? Assets carrying value. The assets carrying value is 286 million, right? The assets carrying value is 286 million, right? Now, I would like to say something. I would like to give you all a point, which was same as the fair value. Which was same as the fair value means the examiner tells y'all, the examiner is telling y'all simply this, guys. The examiner is telling that the carrying value is equals to fair value, right? Or in another way, he is telling y'all the carrying value is valued at market value, right? So therefore, y'all don't need to do any upward or downward adjustments in terms of fair value, right? All are given at market value. So you all don't need to do any upward or downwards adjustment, right? That is all in relation to your very first paragraph of exhibit number 1, right? Let me break off the ice. You all don't need to read paragraph number 3 to answer your first requirement, right? You all don't need to read paragraph number 3. So this is for now. Let us cut it off. For now, we do not need this, right? If I need to answer my 4-mark requirement, I will just need to read first paragraph and the second one. That's it. That is all I need to do. Okay. So now let me use a blue color highlighter. The remaining 70%, obviously, the remaining 70% would be owned by non-NCI, right? Who are the other investors? Who are the investors? Now comes in the best part, right? None of them, none of the other investors own more than 10%, right? So that means you show, right? You only own 30%, and the remaining other investors, they can be 100 investors, they can be 500, 600, 1000, no problem. Regardless of the number, maximum an individual investor has is only 10%. Maximum an individual has is only 10%. So by now, so by now, right? By now, you all might be thinking, guys, you all might be thinking, am I the major investor? Is Chuckle Co the major stakeholder of the company, right? Of Greenco, is Chuckle Co the major stakeholder? Why? Chuckle Co has 30%. Other investors only have 10%. Okay. Let us read on to understand. Let us read on further to understand. Analysis shows all shareholders have been voting independently. Okay, no problem. No problem. Okay, let me stop my reading session, guys. Uh, and I'll start on building my answers. And when I need, I will come into this paragraph and grab in points. Right? For now, this is more than enough. Right? So first of all, as I told, I will follow my very own blueprint. Right? I will go and give the definition of associate, and I will go and give the definition of subsidiary. Okay. So I'll be marking only points, guys. I have already handwritten whatever that is relevant, right? You all don't need to follow my answer patterns at all. You all don't, sorry, follow my patterns. You all don't need to follow my answers, right? You all don't need to follow my answers. You all don't need to follow the examiner's answers, right? But make sure you follow my patterns, guys, because I have tried to make sure that it is in a simplest manner, right? Okay. So you all need to mention IAS 28 because that's the relevant standard, or that's the related standard for an associate, right? And you all need to mention something known as significant influence. Obviously, when you all are associates, you all will be getting significant influence, right? You all don't get control, you all get significant influence. Okay, always remember, associate, he doesn't have control, he will have significant influence. Over what? Over the operating and financial decisions. Okay, over operating and financial decisions. That means, guys, uh, for example, he will tell you how many number of staffs that you need to hire. He will tell you the organization's layout, flow plan, right? He will tell where do you go and invest. He will tell you where do you go and get the sources of funds. Some of that sort. He will be influencing. He would not be able to control, right? And after that, I would go and mention about his voting rights, right? He only has 30% voting rights. That is it, guys. That is it in terms of definition of associate, right? That is it in terms of definition of associate, right? Now, I would move on to subsidiary. Right? If you need to determine subsidiary, guys, you need to have something called as control, right? Control is mentioned in IFRS 10. Control is mentioned in IFRS 10. And I guess IFRS 10, I already explained to you all in a question known as Greco. I guess Greco. It has to be Greco. I mentioned that in Greco. Either one of the questions, guys, we did IFRS 10 control, right? So for the people who have watched it, you all could start writing the conditions by your own. For the people who have not watched, make sure I'll go and read IFRS 10, which is about one page in Kaplan study text, and one entire slide in Study Hub, right? It's quite simple standard. You all can go and read. By 30 minutes, you all be able to finish off the standard, right? That standard gives us three conditions. If I need to have control, I need to meet three conditions. If I meet the three conditions, right, I am known as subsidiary, right? I am known as subsidiary. What are those three conditions? I need to have majority of the power, right? I need to have majority of power, majority of power. Okay. What does this mean? I need to have high voting rights. Or simply for your understanding, if I have more than 50% of voting rights, that is known as majority of power, right? That is known as majority of power. That is a very number one condition. Okay. Second condition would be, right? I need to have right to receive variable returns, right? I need to have rights to receive variable returns. Let me explain. I guess I have already explained, but anyways, let me explain what is a variable return, right? See, now I am investing in a company, right? For example, I'm investing 30% in Mercedes Benz. I'm investing 30% in Mercedes Benz, right? In currently this year, Mercedes Benz in 2020-24, they were able to generate a profit of 100 million, right? And again, next financial year, also they were able to generate 100 million. And consequently, they are only generating 100 million for the coming years, right? Those are known as fixed returns, right? Those are known as fixed returns. And normally, investors like me, right? We don't like fixed returns, guys. Why? Because there are some investors who like to take risk. There are some investors who like to take risk. They don't want fixed returns. They want variable returns. Variable returns means they want their return to vary, right? To current year would be 100 million. The next year there would be a growth of 120 million, right? So therefore it has been increased by 20%. The 2026 year, right? 2026 year, it would have been increased by 40%, right? 2030, it would have gone for 100% increase, right? That is what you all know as variable returns, right? None of the investors want fixed returns. They want variable returns, right? They want variable returns in profits, right? In profits. These needs to be, there need to be a sustainable growth, right? You all need to have sustainable growth, guys. It has to gradually increase. Initially 20%, after at 40, after at 60, after at 80, like that it needs to increase gradually rather than directly going into 100. That is all you all need to know in terms of variable returns, right? You all need to have rights over the variable returns, right? And finally, you all need to be able to affect those variable returns, right? You all need to affect those variable returns. Or simply, guys, you all need to, what I would mean is your decisions, right? You all will be able to control. You all will be telling, here, see, go and invest here. Go and invest in this particular investment. We will be able to get returns. Or, sack these particular employees. We'll be able to have some cost savings. Get quality products, right? Get quality products so that we are able to boost our sales, reduce the marketing expense. These are all factors that how you all affect the profits, right? How you all affect the profits, right? How you all affect profits, right? This is all you all need to write in terms of definition, right? This is definition one. This is definition two, right? This is all you all need to write in terms of definition, right? This is all you all need to write in terms of definition. Okay. Now we need to relate it to the paragraph. Now we need to bring in evidences. Now we need to bring in evidences. Okay. What evidence I will start off with? Can you see here? Read this final line of your second paragraph. Chuckle Go and Green Co share some key management personnel, right? Share some key management personnel. What does this mean? What does this mean? Normally, when you have key management personnel, such as the CEO, right? This means you have control, right? This means you have control, right? When if you all own key management personnel, or if the CEO is right under your company, right? If the CEO listens to you, right? That means it is a factor of control, right? It is a factor of control. Now you all might be thinking, how come I only have 30% and this point is contradicting? Well, examiner, he likes to twist. He likes to twist and give you all. He likes to twist and give you all. That is why you all need to, you all need to be lawyers. You all need to prove. You all need to provide them with proofs. Here, see. Here, see what I have given. Here, see. Here, see. Although they have equally joint share of control, right? I agree, guys. I agree. Yeah, they share the key personals or they share the CEOs. No problem. Let them share, right? Which is an indicator of control, right? Let it be. No problem. This is an indicator of control. Let it be. No problem, right? IFRS 10 says one of the factor to show that it is a control or not, you need to have key management person who is the CEO, right? CEO or the board of directors must be under you, right? He should be able to listen to you, right? That is how control is justified, right? But you only have 30% of voting rights, guys. You only have 30% of voting rights. Does this mean that you are able to control a company? No, right? With 30% of voting rights, you are not able to control a company. You all are not able to control a company, right? And also, you all don't have future potential voting rights, right? That means what I mean is, you all are, there is no indication in this paragraph in your very first exhibit. There is no indication saying that you all will be able to purchase some more shares, right? You all are going to extend or you all are going to increase your number of shares. They are not mentioning. So we can conclude that there is no control, but only significant influence, right? Hopefully all got, hopefully all are able to understand. Let me again explain it to you. Let me again explain it to you. How I came, what I did was, first of all, I agreed with the examiner. I agreed fine. Under IFRS 10, this is an indicator of control. Why? Because they share joint control. I simply agreed. After that, I countered. I counter attacked by saying, look at this, even though that is an indicator of control, I only have 30% voting rights, right? And I'm not going, I mean, this paragraph does not say anything about me further investing, right? So I can conclude, I rest my case that this does not have control, but it has significant influence. This is proof number one. This is proof number one. Okay. Now comes in proof number two. Right? I'm going to give him another argument. I'm going to give him another argument. Right? Look at this. Look at this. By referring to the 30%, right? And the remainder is owned by, obviously, the remaining is owned by the other investors. No, guys, you all only own 30% and the remaining is owned by other investors who do not exceed 10% of voting rights, indicates that Chuckle has control. Now, see, I'm giving him my opinion. In this proof number one, I was speaking about his opinion. I gave counter attack. Now I'm bringing my opinion. Obviously, right? When other investors only own 10% of voting rights and you own 30%, I told you all right. I bought in a question. Do we need to think that you all are major investors, right? If you all are major investors, do you all have control? Do you all have control? Well, that is what I'm bringing here. That is what I'm telling you all here. I'm bringing in my own point now. However, however, right? Based on the analysis, right? Based on this analysis, can you remember? Analysis shows that all shareholders have voted independently. They have voted independently. That means even though they are small investors, right? They decide who do they vote, right? They decide who do they vote, right? They decide who do they vote. You see, based on the analysis, they are not able to influence to gain control. What does this mean? What does this mean? See, obviously now we might be thinking that we have control, right? Obviously, if you have control, guys, you are able to you are able to direct the other investors. The small investors of 10%, you all are able to direct them, right? That is what we think. Why? Because we have 30% and they only have 10%, right? But no, no, that is not at all. That is not it, guys. Just because you all have 30% and they have 10%, they only take their own decisions. They only take their own decisions. How do I justify it? Here, see, they take independent decisions, right? So far, they are taking independent decisions. They do not rely on Chuckle. Even Chuckle has 30%. Even though Chuckle has 30%, they do not rely on Chuckle because they take independent decisions. That is what I am meaning here. You see, due to independence. You see, that is what I'm meaning here, right? Even though they are not connected and they are not dispersed. What does this mean? What does this mean? Even though they are not connected and dispersed. Obviously, right? This entire 70% is not owned by another investor or another equal shareholding investors. That means equal shareholding means 35% each, right? These are owned by multiple investors. So that's why they are dispersed. It can be hundreds, it can be 500 investors, it can be 1,000 investors, and also they are not connected means, guys, obviously it's not owned by two parties, right? One will have 35% and the other one will have 35%. So this is how I would bring in proofs. This is how I would justify that this is not control. This is not control. And finally, I would conclude, right? I would conclude saying that the examiner was correct to classify this as associate, right? This is how I would answer this particular question, right? I would bring in two definitions, right? I would relate to the paragraph. How I would relate to the paragraph? I would first say that, yes, examiner, you are correct. And after that, I would counter attack with my point. Okay, I would counter attack with my point, as well as I would bring in the independency, right? I would be bringing the independency. Why? I initially thought by reading the paragraph, I thought that they had major stake, right? Because they had 30%, the other investors only had 10%. So I thought they are the major stakeholders, they have control. But no. Why no? Why no? Because see, even though they only are small investors, they are able to take their very own decisions, guys. They are able to take their very own decisions, right? They are independent decision makers. They are independent decision makers. So we do not have control, right? We do not have control, right? We do not have control. Therefore, examine as correct to classify them as an associate, right? Uh, and there's another one, guys. I wanted to give you all. There's another one I wanted to give you all. This is not related at all. You all know, but you all need to know this, right? You all need to know this for your professional qualification, right? Whatever the jobs that you all are performing, you all need to know. What do I mean by bargain purchase? What do I mean by bargain purchase? What do I mean by bargain purchase is, it's quite simple, guys. Bargain purchase. What do I mean by bargain purchase? Look at this. You all paid only $100, right? You all paid $100 for assets worth of 286 million. Can you all see? Can you all see? You all only paid 100 million, but you all got asset worth of another company which is worth of 286 million. That means you all have got high assets for less cost, right? This is what you all call bargain purchase. This is what you all got called bargain purchase. Yes, you all have got 286 million of assets by only simply paying 100 million. By only simply paying 100 million. That means your CEOs, your board of directors have good bargaining power. Bargaining power, right? This is not needed. This is not needed at all. This is not needed. This is just a tip, right? This is just a tip. Okay. This is not needed at all. This is just a tip of what is bargaining power or what is bargain purchase, right? You all are simply going and buying lot of assets, right? You all are buying multiple assets for a relatively lesser cost. That is what you all known as bargaining power. You all can use it wherever you all see. Okay. That's how you all understand. So we are done off with our very first question, which is a 4 mark, right? We are done off with the very first question, which is a 4 mark. Now let us move on to our second requirement, which is a 3 mark question, right? Which is a 3 mark question. Hopefully you'll understand how we do this. Simply write the definitions of associate and a subsidiary, come up with a conclusion, right? To come up with a conclusion, you all need to relate it to the paragraph. Give the examiner proofs. Okay, give the examiner proof. Now see, this is, you all can give one proof, but to be on the safe side, I made sure that I give two proofs so that we are able to get the point. Okay, we are able to get the point. Okay. Now, your second requirement. Your second requirement. Hopefully, you all have understood your first requirement, right? Hopefully, you all have understood. If you all have not, right, please raise your hands or please ask me whenever you all could. Okay, whenever you all could, please ask me. Using again exhibit 1, using again exhibit 1, again he wants me to explain. What does he want me to explain? He wants me to show the accounting treatment of equity method, right? Of Chuckle. So let me give all a let me give you all a funny part. Let me give you all a funny part. Examiner is already telling that this is equity method, right? That means obviously this is an associate, right? Obviously this is an associate. He's giving us tip, guys. Can you see? He's giving us tip, right? In here, he's already puzzled. He doesn't know whether it's an associate or a subsidiary. But by reading the second requirement, they are using equity method, right? Obviously, you all know equity method is only used in associate, right? Equity method is only used in associate. So you all don't need to even wait until proving, right? You all don't need to wait until proving. You all can directly jump into a conclusion. You all can directly jump into a conclusion that he's an associate. Okay. That's the funny part of it. That's the funny part of it. You can directly jump into conclusion, but I would say don't take risk. I would say don't take risk. Make sure that you all read the paragraph, right? For the lazy buggers, make sure you all read the paragraph, right? This is your last financial reporting question, your last subject in terms of financial reporting. You all are not again going to do it. Okay. Okay. Now he wants us to speak about the accounting treatment of equity method, right? For that also, I'll tell you all how do you all grab 3 marks. For that also, I'll tell you all how do you all grab 3 marks, right? How do I grab 3 marks? You all can simply go and tell equity method is using IAS 28, right? Equity method is using IAS 28. Okay. This will be presented in a single line item. Okay. Under non-current assets. Under non-current assets. Obviously, right? You all know if you all go and invest in investment in associate or investment in joint ventures. If you all go and invest in investment in associate or joint ventures, they will be presented, they will be presented under non-current assets. Non-current assets as a single line item, right? For example, you all will be having PPE, right? After you all will be having current assets, right? You all will be splitting it up as investment in associate. This is how you are presenting. This is how you are presenting. You all be keeping a simple line and after that showing this as a separate line, right? This is what I mean by this particular point. Okay. As per IS equity method, right? You all can say that will be used in associate or joint venture who has significant influence, right? You all can bring in this also. This is not needed, right? I'll only mark you all what is the needed points. I'll only make sure that I mark what is the needed points, right? Also, share of profits from associate, okay, will be indicated in other income. Why did I bring share of profits, guys? Why did I bring something called as share of profits? Wait, my highlighted did not work. Will be indicated in other income. See, the examiner's requirement is he has not mentioned whether it's consolidated financial statement of SOFP or SOPL, right? He has not mentioned. So he has not mentioned whether it's I need to relate it to the SOFP or SOPL, right? So that is why I need to show how do I present it. I am telling him how do I present it in both ways. In SOFP, it will be shown under non-current asset. In SOFP, it will be shown and under non-current asset. Okay, give me a minute, guys. Give me a minute. Give me a minute. My mouse pad is stuck a bit. Sorry. Where was I? Okay, here. In SOFP, I'll be showing it under non-current asset. In SOPL, right, I'll be showing it under other income. Other income as, right, share of investment in associate profits. Obviously, right, if I invest 30%, I'm not going to just simply invest, right? I get profits. How much do I get? Do I get the entire 100% of the other company's profits? No, I only get 30% of other profits. That will be shown under other income. That is what I have mentioned here. That is what I have mentioned here. Then after it, I simply tell how do I do this calculation, right? What I would do, I would show the cost, right? I would show the cost, which is at fair value, and I would increase it by net assets, and I would reduce or I would remove any intra-group dividends. Right? You all know, right? If you all are part of the group, you all are not allowed to bring in dividends. Intra-group dividends are not allowed. Right? Intra-groups are not allowed. Then after that, I would move on to the calculations. Then after that, I would move on to the calculations. Let me do that for you. Let me do that for you. Let me do that for you. Let me do that. Well, calculation is quite simple, guys. How much did you all invest? How much did you all invest to buy 30%? How much did you all invest to buy 30%, guys? You all only invested 100 million. Okay, you all invested 100 million, right? You all invested 100 million. And how much? Now, here, now let me come. I have to read this paragraph, which I cut over earlier. I need to read this paragraph, right? I need to read this paragraph. The carrying amount of net assets on 31st March 2006, right? That means at the reporting date is 348 million, right? Opening net assets was 286, closing net asset is 348. The increase in net asset was solely due to profits. So I believe that this they are speaking about is the retained earning reserve, right? They are speaking about retained earning reserve. Obviously, right? Only profits will be affected in retained earnings. Only profits will be affected in retained earnings. So I guess the only net asset, I guess only the net asset that this company has is their retained earnings. So the opening retained earnings is 286. The closing retained earnings is 348, right? The difference was the profit. The difference was the profit. The difference was the profit. Okay. So how much would be the profits? How much would be the profits? 348, right? 348 minus 286, right? Minus 286. This would be the profits, guys. This would be the profits, right? Do I own the entire profits? Do I own the entire net assets? No, I only earn, or I only own 30% of it, right? I only own 30%. So I only own 30% of it, of the retained earnings or the profits. I only own 30%. Okay. I only own 30%. Okay. So I'm showing you all the workings also separately so that you all don't, when you're referring, you all will not have any problems. Right. So at reporting date, right? At reporting date, how much would be my investment value? My investment value would be cost plus my share of net assets, right? My investment is supposed to be 118.6 million. 118.6 million. That is what my investment is supposed to be, right? That is what my investment is supposed to be. Hopefully, all have understood. Hopefully, all have understood. How did I come? How did I come up with the investment? How did I come up with this investment, guys? I simply took the cost, right? And I showed the share of net asset, right? Minus any dividends. Okay, minus any dividends. There was no intra-group dividends, right? You see, they did not pay any intra-group dividends. Okay. And how did I come up with the retained earnings? Right. What I did was I took I took the closing retained earnings and subtracted it from the opening to find out the profits. Will I get the entire profits? No, I only get 30%. Right. So finally, in my non-current asset under investment in an associate, I would be going and recording 118.6 million. This is the this is the one that I need to present, right? If you all ask me in terms of share of investment in net assets, here it is. My profit would be only 100 and my profit would only be 18.6 million. My profit would be only 18.6 million, right? How is that 18.6 million? The entire group would have got group would have got 62 million of profit, right? Out of the 62 million, I only get 18.6 million. Why? Because I am a 30% investor, right? I only get 30% of the profits, right? This is it. This is it. This is it. Right here. Here it is. If they ask investment in associate, you need to show 118.6. How did I come? Cost plus share of net assets, right? And if they ask in share of, if they ask in SOPL, guys, you all can simply go and show, right? Out of the profits, you all will only get 30%, which is 18.6 million, right? Now, did I tell y'all? Did I tell y'all when I was reading? I guess I did not mention it. I'm really sorry. I did not mention it. Here it is. Examiner has done a mistake, guys. Examiner has done a mistake. What he has done? What he has done? Greco has been stated at cost. This is a problem. This is a problem. What they have done, rather than showing 118.6 million, right? Rather than showing 818.6 million, how 118.6 million is made? The cost plus the share of net assets. The examiner has only gone and mentioned cost, right? So what he has done, he has not told the investment in associate is valued at 118.6. He has gone and reported that the investment in associate is only 100 million. He has forgot to do the share of net asset part. He has forgot to report the share of net asset part, right? So that is wrong, right? Obviously, that is wrong. He is understating the investment. He is understating the investment by 18.6 million. That is what I have mentioned here. However, they have understated, right? They have understated the share of, because why? They did not include share of net asset. They forgot to include share of net asset. If you all see, if you all need to calculate the investment in associate, you all need to have three factors. One is the cost, the other one is the share of net asset minus any intra-group dividends. This fellow, this examiner, he has forgotten to take share of net asset, right? That is why they have understated, right? So we need to do an adjustment. We need to adjustment. We need to do an adjustment. We need to do an adjustment to increase it by 18.6 million. Obviously, right? The investment is understated. The investment is understated. So now what do you need to do? If it's understated, you need to bring it to the real value, which is 118.6, right? So okay. Now my question would be to you all is, right? You all would have studied this in FR. You all would have studied this in FR. Right? You all would have studied this in FR. You all are at 31st March 2006. You all are at 31st March 2006. Okay. You all are at 31st March 2006. This error was done in 2004. This error was done in 2004. Let me mark that as an error for you all. Right. This error, guys, was done in 2004. So you all know any prior year adjustments, right? According to according to IAS 8, right? According to IAS 8, any prior period adjustments, right? Any prior period adjustments, you all need to adjust it retrospectively, right? Any prior period adjustments, you all need to adjust retrospective. Now I'm not going to explain what is retrospective and all, right? According to IAS 8, what does IAS 8 says? If there is an adjustment in your previous financial years, what you all need to do is you all need to adjust the simple opening balance of your retained earnings. Go and adjust the retained earnings. You all need to adjust the opening balance of retained earnings. This I did not come up. This I did not come up. This is a standard known as IAS 8, right? IAS 8 says if there is a prior period adjustment, if there's a prior period adjustment in your previous financial years, right, which is material, right, which will affect your financial statements, those adjustments you all need to adjust in your current, right? You all need to adjust. Let me mention that also in the current year opening balance of retained earnings, right? These all you all need to know to get your 3 marks. These all you all need to know to get your 3 marks, right? The best part I would say is, out of this question is this error. This error only is the best part. Apart from that, the rest you all are able to manage. It's quite easy. Apart from that, you all are able to manage the rest, right? So I would say guys, I would say A requirement was the easiest out of the lot, right? C would consume time. C would consume time. B is also manageable, but A was the easiest. A was the easiest. Okay, so simply don't leave out marks and don't lose your hope, right? Be motivated, be confident. Exam is easy, guys. Exam is easy. Okay. No, no, no. I'll give you all 2 minute break first when we are attempting C question. I'll give you all 2 minutes break when we are attempting C questions. Let us soon finish off B because that's also another 3 mark, very small requirement, right? So I don't want to give you all breaks. I'll give you all a 2 minute break when we are attempting C, right? The pre-populated sheet, which is a 12 mark question, right? For B, let us continue. For B, let us continue with another color pen. Here it is. Now they want us to use exhibit 2. What do you want me to do, examiner? What do you want me to do? You want me to explain, right? He wants me to explain briefly. Okay. He wants me to explain briefly how the classification would change, right? On 1st April to a subsidiary. So what the examiner wants me to discuss, I guess what the examiner wants me to discuss. So far, we have been treating as an associate, right? Requirement number A, we have been treating it as an associate. Now the examiner tells that we need to treat it as subsidiary. If so, bring in justifications by referring to exhibit 2, right? So I need to read exhibit 2 for me to understand why does he want me to bring it to subsidiary? Why does he want me to bring it to subsidiary? Here it is. Here it is. Chuckle Co acquired a further 18%, right, on 1st April 2006. Okay. So initially you all had 30%. Now you all bought 18%, right? So you all own 48%. You all own 48% on 1st April 2006. Is examiner mad, guys? Is examiner mad? Obviously he knows, right? We only have 48%, right? If I need to be termed as subsidiary, if I need to be termed as subsidiary, guys, I need to have control, right? Or I need to have more than 51%. But here only they only have 48%. Does this mean do we have control? Does this mean do we have control? Right? You all need to ask from your. Does this mean we have control? You all need to ask from all this very question. Okay? Let us read on. Let us read on again. The remaining 52%, okay, is owned by few other investors. Okay, none who own more than 10%. Okay, here again the same thing arises. Right here again. Does this mean we are major shareholders? Right, obviously, right? Now you all have 48%, right? The other investors only had 10% each, only have 10% each. So does this mean we are major shareholders? Okay, does this mean we are major shareholders? Okay. Okay. For this, of course, guys, I guess I need to read the final paragraph as well. Right? I hate reading. I hate reading. So okay, let me soon grab in the important points. On 1st April 2006, Chakulco also acquired, right? They did not only buy 18%, they also acquired share options. Okay. What does this share option do? What does this share option do? Right? It helps us to exercise, right? It helps us to exercise, right? And also this share option is only valid until 31st March, which is the next financial year. So it's only valued until 31st March 2007. Only for 1 year it is valid. So between that, we need to exercise it or otherwise we need to lapse it, right? We are given the option, we can exercise it or we can lapse it. Hopefully, I'll know what's the meaning of share options. Hopefully, I'll know what's the meaning of share options. Okay, for the people who don't know share options, well, share options is like guaranteeing. You all are fixing the price, right? You all are fixing the price of a 2018 share right now. right? For example, say you all are locking now. For example, take the share of Tesla. Today, the share of Tesla is $100, right? You all don't know what's the value of Tesla in another 5 years, right? But you all will lock a price saying that okay, it might be about $400 in 5 years. Fix that price. That is known as share option, right? That is known as share option, right? So in another 5 years, when you all are in the fifth year, you all will be looking, okay, at that time, if it's more than 500, you all would not exercise it. Why? It's no point. Sorry, at the market, sorry. At the market value, in another 5 years' time, at the market value, if that particular share is being sold at $600 and you all have a share option which is saying that you all have valued it at 500, obviously you all are having a gain, right? When the entire market is buying at $600, you all will be only buying at 500. Why? You all had a share option, you all locked the price. Okay. Another instance, suppose if the market value in another 5 years was only 300, right? You all have locked the share option for 500. You all are at a loss. Why? The entire market is buying at 300. Why do you all need to go and buy at 500? Okay. That is what you all mean by share option. Okay. For the people who need, right, I'll share an article or I'll share a website or you have to go into Google and check what is the meaning of share option. Okay. What does the share option do for us, guys? What does the share option do for us? Right, let me read on. The exercise price of option on 1st April 2006 was just above the markup price, right? That means, guys, I told you all, right? Say markup price is $500 and your share option is, guys, your share option would be $800. Does this seem reasonable to you all? Does this seem reasonable? When you can buy the exact same share, when you can buy the similar share in the market for $500, why would you go and exercise it for $800, which is an agreed price? Why would you go and agree? Right? Look at this. I did not go and agree. Here, see, examiner saying the exercise price, right, was above the current markup price of Green's share. Why do we need to go and do when I can get this exact same similar share for $500? Why would I go and exercise my option for $800? Well, here see, even though this, even though this is a loss in terms of finance, right? Is a loss in terms of finance, right? There are some other synergy benefits. Other synergy benefits, guys. Right? There are some other synergy benefits. Okay. I'll explain to you. I'll explain to you. Even though these are being sold at the market, guys, for $500 and they all are going to exercise it at 800, it's totally absurd, guys. It's totally absurd. It is a loss-making transaction, right? In your financial perspective, it's a loss-making transaction, right? You all are incurring $300 of loss, right? But there are some companies, they intentionally do it, guys. They intentionally do it. They intentionally create losses. Why? Because sometimes there might be synergy benefits. Synergy benefits means there are some other benefits. Okay, there are some other benefits. We will need to read on to identify. Here, see, Greenco has been profitable for a number of years. That means they have a history of profits, right? They have never been at a loss, right? So obviously we can, incur some losses initially and recover because why? They have a profitable history. Obviously we can incur some losses, right? By exercising our share option, which is only one time expense, which is only a one time expense. Obviously we're not going to exercise it always, right? We will exercise it one time. We will incur a loss. Yes, no problem. But we will recover. Can you all see how they are thinking? They are thinking long term. They are thinking long term. For the short term investors, we feel that loss is a bad thing, right? For the long-term investors, guys, what they do, they initially incur a loss, and because of the financial performance, it has a profitable history, right? They will recover the losses, guys. That's how they do. That's how investing works. That's how share marketing works. You all will initially incur losses. After that, you all will make sure that you all recover it through profits, right? That's how you all do. You all buy a undervalue asset, and after that, you all will overvalue it. That's how you all do share market. Okay. Sorry, I deviated. Sorry, I deviated. Okay. Since they had a profitable history, right? It's ideally good. That is one of the benefit. That is one of the benefit. And also, their share price has an upward movement trend, right? Upward movement trend. That means it's like this. It goes like this, right? Slowly, slowly, they would increase. Have you all seen share markets, guys? Have you all seen share markets? Have you all invested? Right? It goes like this. It has an upward trend. Can you see? This is called the trend. This is called the trend. Okay. Obviously, right? No problem. Initially, this you all might be incurring a $300 loss, right? But you all can recover through profits, or you all can sell your shares. Why? Can you see these shares have upward trend, right? They are not going to fall. They are not going to have a downward trend. They are not going to fall. Okay, that is what you all mean by upward trend. Okay. Also, here comes the best part. It will increase its ownership to 60% if you exercise its rights, right? By exercising this particular option, guys, you all are able to gain 60% of ownership. You all are able to gain 60% of ownership. What do you all mean now? What do you all mean now? 60% of ownership means, guys, you all have control. You all have control, right? You all have control. That is what you all mean by 60%. By incurring a loss, you all are able to get 60% ownership. Share prices you all can sell and gain, because why? Because share prices has an upward adjustment, and also these are having profitable history, so you all will be able to get dividends. Also, you all have cost savings because of buying these shares. Okay, so that is why if you all include all of those points, you all can come into conclusion that this is a subsidiary. That this is a subsidiary. Okay, here it is. Here it is. I have mentioned. Here it is. Here it is. I'm simply asking myself. I'm simply asking myself. Initially, it was an associate. Now, why do you want me to change it as under subsidiary? Okay. Why do you want me to bring it under subsidiary? This is the question that I would ask my very own self. Okay. Here it is. And I would argue also. So it's like this, guys. You all have to argue in a way, in a smart way. You all need to argue with the examiner. All right. What I will do is, you see, due to the additional purchase, right? Due to the additional purchase, they would be how much on 1st April 2006? They would be only 48%, right? I would tell that the examiner, this is still an associate. This is still an associate. Why? 30% plus the 18% additional acquisition will show me that I only have 48% of ownership, right? There is no control. There is no control, so therefore there is no subsidiary. That's how I start my paragraph. That is how I trick the examiner, right? However, however, right? However, however, with the additional share options, guys, can you see here? You all have bought that additional share options, guys. That share option, that share option, that share option will give you all or will give you all the tendency to increase your voting rights to 60%. Obviously, now when you all exercise that, you all are getting 60%. Then what do you all call yourselves? When you all have more than 51% of ownership, you all have control. If you all have control, you all are known as subsidiary, guys. You all are known as subsidiary, right? Only if you all exercise, huh? Only if you all exercise that particular share option only, you'll be able to get 60%, right? So that is what I'm telling here. You see, however, if there is additional share options, there is a tendency to increase the voting rights to 60% by exercising them, right? This is what I'm telling. Okay. Now again, as usual, what I would do is I would tell, I would tell the pros and the cons, the pros and the cons. This is not economically effective. Why? Obviously, initially you all incur losses, right? Short-term investors, they don't like losses. They always want to see profits, 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 right? But the long-term investors, they know. Long-term investors, they know, right? Since these share options are expensive, obviously, right? More than the market price. More than the market price. Market price is 500, you all are exercising it at 800. But you all will be getting synergy benefits. What are the synergy benefits? They are profitable, right? The share prices have an upward trend. You all can sell it in the future for a higher price and get, because of profitability, you all can get dividends, and also you all get control. You all get control. Okay. You all get control. And I forgot to mention there's another one. There's another one. You all get something called as cost savings, right? You all get something called as cost savings. So now I come up with a conclusion, right? Which would get my third mark, right? I would conclude. Also, finally, since the remaining 52% is owned by investors, right, who are dispersed and unconnected, right? Again, I'm bringing that same point. What am I saying? That these 52% investors, guys, they cannot come against me, right? They cannot come against me. Why they cannot come against me? Because they are not connected, guys. It's not owned by one investor. It's owned by multiple, dispersed, right? Multiple investors, right? And they are not connected also. They are not part of one Tata group of companies, or they are not part of one Mercedes group of companies. No, they are unconnected and they're dispersed. So therefore, what I would tell them is, due to this, they have control. So they are a subsidiary. They are a subsidiary, right? They are a subsidiary. This is how I come up, guys. First of all, I will agree with the examiner. I will pretend to agree with the examiner. I will pretend to agree with the examiner. After that, I will counter attack him. And after that, finally, I'll come up with my conclusion. It's my conclusion. Conclusion. Right? This is my conclusion, guys. This is my conclusion. This is my conclusion. Okay. And also, obviously, when you all start when you all have control, guys, you all need to start what do you call, you all need to start consolidating. Okay, that is it in terms of a B requirement. So you all now all together, guys, if you all have done perfect answer, right? There's nothing called perfect answer. You all will be able to get about, say, roughly about 7 mark is totally yours, right? So far, none of the people have scored 100 out of 100 for SBR, right? So you all don't need to worry. You all don't need to try to be a perfectionist, right? You all can simply handle this question, right? I'm pretty much sure you all will be able to get about 8 or 7, minimum 6, right? By doing A and B, minimum 6, maximum 8 to 9 mark, maximum 8 to 9 mark. Okay, by attempting only A and B. So what is left? What is left? You all only have another 22 marks to pass. You only have another 22 marks to pass. Okay, you only have another 22 marks to pass. Okay. Now let me read the C requirement. Let me read the C requirement. Yeah. Again, the examiner wants me to use exhibit number 2, right? He wants me to explain, okay, explain the way of accounting of that 18%, guys. He wants me to show how do I account that 18%. Now he doesn't want us to calculate, okay? He doesn't want us to calculate. The verb that is used is explain. The verb that he is using is explain the accounting treatment, right? Explain the accounting treatment. It's only for 2 mark. You all don't need to have detailed explanations also. You all don't need to have a detailed explanation. What you all can say is, these are step-up acquisition, right? These are step-up acquisition. How it is a step up acquisition? Initially, you all bought. Wait, let me draw that also. Sorry, sorry, my bad. Wrong graph. It's supposed to be initially you all bought 30%. Now you all are buying 80%. After that, you will again slowly buy 60%. Can you see you all are going like a ladder or a step? You all were 30, then you all go to 48, then you all finally go to 60. This is known as step up acquisition, guys. This is known as step up acquisition, right? This is what you all call step up acquisition, right? When there is step up acquisition, guys, the standard says, right? The standard says, I'm not able to recall exactly. It's either IFRS 3 or IFRS 10. Right? I guess it has to be IFRS 3. I guess it has to be IFRS 3. IFRS 3 states that if you all are doing step up acquisition, you all need to remeasure, right? You all need to remeasure the previous held associate, right? You all need to remeasure the previous held associate at fair value, right? It's not two, it's at fair value. At fair value. Okay. So what does he say? What does he say? I guess you all know the small car big car example, right? You all know the small car big car example. Hopefully I'll remember the small car big car example. What does it mean? What does it mean? Well, it simply means, give me a minute, my highlighters are not working at all. Okay, never. No problem. What does it mean? What does it mean? You all were initially 48%, right? You all were at associate status. All were at associate status, guys. You all were at associate status. But after that, you all are moving to subsidiary status, right? You all are moving from associate to subsidiary. This means from no control to control. Can you see? You all never had control. Associate doesn't give you all control, it gives only significant influence, right? You all are moving to subsidiary. So this means you all have no control to control. Okay. So step up acquisition says that only, guys. When you all move from no control to control, right? And when it's a step up acquisition, you all need to remeasure, right? What do you all need to do? Simple, guys. What do you all need to do is you all need to do something called a small car big car example. You all need to cancel off or simply you all need to sell off this investment and you all need to consider that you all are reinvesting. You all are reinvesting in the subsidiary, right? This is all you all need to know. Okay. Why? Because this 48% is also included in this 60%, guys. This 48% is also included in the 60%, right? Now I'm not going to what you call explain what's a small car, big car example. How do we do step up acquisition? No, I've already explained it twice. This is my third time explaining. You all need to apply step up acquisition, right? Step up acquisition says that you all need to value them at fair value, right? You all need to remeasure them at fair value, right? Why? Because initially you all were at 48%. You all need to consider that you all are disposing it off or selling it, and after that repurchasing from no control to control, right? From no control to control. So you're selling off the no control and getting off control, right? Okay. And any difference, right, will be transferred to P&L. Obviously, you all will be having a gain or loss. Okay. When you all sell, guys, when you all sell these investments, okay, when you all sell that associate and you all are being transferred as subsidiary, right? Comparison between the fair value and the carrying value. Fair value of investment and carrying value of investment. Any difference is the gain or loss. That is only taken to P&L. That is what I have mentioned here. That is what I have mentioned here. Okay. You all need to simply mention that, guys. You all need to simply mention that. You all need to simply mention that. How do you show that accounting? Okay. You all need to simply mention that. Okay. Also, we are finally left off with another one last point, right? This point is even I personally forgot. Even I personally forgot today when I'm drafting, and after later on when I when I reread the examiner's answers only, even I was able to recall, right? Obviously, when you all gain control, right, you all will need to do group consolidation and goodwill, right? You all need to do goodwill. Okay, you all need to calculate goodwill. Okay. So when you all are doing goodwill, guys, this will include the fair value. This would include the fair value of 48%, not 30%, sorry. It would include the fair value. That is why we need to do remeasurement. You see, we need to remeasure the associate. This is why we are remeasuring. Why? Because we need to show them in goodwill calculation. If we need to show them in goodwill calculation, you know goodwill is valued at fair value. Goodwill, I again repeat, goodwill is valued at fair value. So you all need to remeasure them to fair value. The 48% has to be remeasured them at fair value. Okay, is valued at fair value. This is it. This is it that you all need to explain. This is it you all need to explain in how to account that remaining 80%. This is it you all need to know on how do you account that remaining 18%, right? Simply speak about step up acquisition because they are not buying the entire 60% at once. They are buying it chunk by chunk. They go 30, then after 48, then after that 60. That is known as step up acquisition. When step up acquisition happens, you all need to do the small car, large car basis. If you all are moving from no control, again I'm repeating myself. If you all are moving from no control to control, right? If you all are moving from no control to control, you all need to do small car, big car example. Any difference between the fair value and the carrying value, right? You all need to transfer that to P&L. Why does the different occurs? Why does the different occurs? Because you all are simply considering yourself, you all are selling the associate and reinvesting in subsidiary from no control to control. That is it. That is it. Right? And as usual, right? I forgot this point. I don't want you all to forget. Right? Where does this another 18% affects? It affects in my goodwill. It affects in my goodwill, right? It affects in my goodwill. You all need to value the entire 48%. The entire 48% has to be valued at fair value. Okay, that you all need to mention. That also you all need to mention. Okay, that also you all need to mention. Now we are left off with the second requirement and a pre-populated spreadsheet. We are left off with that. Okay, we are left off with that, which is a 6 marks. Which is a 6 marks. Okay. So examiner wants me to use exhibit 3, right? He wants me to explain fair value adjustments. All right. And he wants to tell the deferred tax. He wants me to show how the deferred tax is calculated and he wants to explain fair value adjustments. So now this is, what does this say? This is IFRS 13 and IAS 12. Can now see how examiner is combining standards. Can now see how examiner is combining standards. Can now see how examiner is combining standards. This is how we can ask questions, guys. He would not give entire question based on one particular standard. He would not give entire question based on one particular standard. He would, he would start combining multiple standards and giving you all, right? Telling you all to explain, telling you all to explain. Okay. So that's a 6 marks question. He wants me to explain the fair value as well as he wants me to show how to calculate deferred tax adjustments. Okay. Today, of course, I'm not going to explain deferred tax adjustments a lot because already we have done one question and you all are, I hope that you all are financial reporting students or people coming from background, various academic backgrounds related to finance, right? Okay. So let me go and read off my third requirement for you. Okay. They have prepared a balance sheet. Okay. The investments, the investment has been stated at a cost of 166 million. No idea. So far, no idea. I don't have an idea about this. Okay. And the net assets, have been included at their carrying amounts. Fine, fine. I don't have an idea about 166. That breakup, I don't have an idea, but let me read on. Okay. The equity of Greenco has also included a balancing figure, right? They have not calculated goodwill. So obviously, I guess they want us to calculate goodwill, but this is not related to your, this is not related to your 6 marks. This is not related to your 6 marks, right? This is not related to your 6 marks. The consideration for the further 18% is 66 million. Okay. I get it. What happens was, guys, we bought this as 100 million, right? We bought this at 100 million, 30% we bought at 100 million, right? And the remaining 18% we are buying as at 66 million. That is what they're showing. That's the breakup, right? Goodwill is not calculated. We need to calculate goodwill. Okay. So far it seems fine. So far it seems fine. Here it is. The fair value of the original equity interest was 127 million, right? Was 127 million. Well, let me say this. Let me say this. Let me tell you. Let me give you. This is not needed. This is not needed. This is for your pre-populated. Pre-pop, right? This is also for your pre-populated, right? How am I telling? It does not speak anything about fair value adjustment. No, it does not speak anything about fair value adjustment. These also not your fair value adjustment question. These are pre-populated, right? Let me read on this paragraph. Let me read on this paragraph, hoping to see that this at least is related to this one. Included within the non-current assets is land, right? The carrying amount of land is 50 million, but its fair value is 60 million. Obviously, or no, according to IFRS 13, this is an upward adjustment, right? This would go and affect your net assets, right? This would go and affect your net assets. When your net assets increase, this would go and reduce your goodwill. Reduce the goodwill, right? How does your goodwill reduce? When there is a net asset increase, right? Does this create excess depreciation, guys? No. Why? Because these are land. Land does not depreciate, right? So this is, I guess, this paragraph is all related to IFRS 13, right? IFRS 13. This, of course, you all can write. This, of course, you all can write, right? You all can write. How you all can write? Obviously, this creates an upward adjustment. Why? Carrying value of this net asset is 50 million, but the market value is 60 million, right? What does IFRS 13 says? It is not entity specific. IFRS 13 is not entity specific, right? It is market. You all need to value your assets at market value. That's what IFRS 13 says, right? So you all need to do an upward adjustments in terms of land. Okay. Another one. They include finished goods at a cost of 84 million, right? The cost is 84 million. The fair value is 131 million, right? So I guess, can you see these net assets, guys? These net assets needs upward adjustments, right? Land needs upward adjustments, as well as what you call finished goods also needs upward adjustments. So before reading the final paragraph, let me go and write. Let me go and start constructing. Let me go and start constructing. Let me go and start constructing. Here it is. Here it is. Before that, I would like to show how these 6 marks is being allocated. How these 6 marks is being allocated. It's like this. Yes, this is how the examiner allocates. This is how the examiner allocates. 2 marks for upward adjustment and the tax impact. 2 marks for finished goods and the tax impact. 2 marks for your database and the tax impact, right? So you all need to start writing like this, right? You all need to start writing like this. At the date of acquisition, it is needed to restate that all the fair value, sorry, you all need to restate all of them at fair value, guys, right? For goodwill calculation, okay? Obviously, these are going to affect goodwill, right? Upward adjustments will affect your goodwill. Upward adjustments would affect your goodwill because you all are increasing net assets. So that is why I bought in for goodwill calculation, right? What does goodwill say? You all need to value all of them at fair value. You all need to value all of them at fair value. Now I bring in the standard. You see, now I bring in the standard IFRS 13, right? IFRS 13 will ensure how to determine fair value, right? It ensures how to determine fair value. What do they mean by this? Obviously, we don't know how to calculate fair value, right? So IFRS, there's a particular standard known as IFRS 13. He will tell us how to calculate fair value. He will tell us how to calculate fair value, right? This is just a general point. This is just a general point. This is not needed, right? This is not needed. But I just bought it as a general point. It's not needed. Can you see here why I bought it? Can you see here? Has examiner allocated any general marks? No, right? So what you all need to speak? You all need to speak about the increasing of 10 million, right? Now I'm going quick, guys. Now I'm going quick because we are running out of time. You all need to speak about 10 million, which is an upward adjustment, right? And land does not have depreciation, so there is no excess depreciation, right? Tax impact, I will speak. Tax impact, I'll speak. Obviously, when your tax base remain constant and your carrying value increases, when your carrying value increases because of the upward adjustment, right? Because it increases because of the upward adjustment, guys, you will have a temporary difference. Why temporary difference arises? Carrying value is greater than your tax base. Okay, you will have a temporary difference of how much? 10. Of how much? 10. Why? Because your land value is now increasing. The carrying value is now going to increase by 10 million, right? Because of the revaluation or the upward adjustment. Tax base would remain constant. So it will create a temporary difference, right? So what would be the tax impact, guys? What would be the tax impact? Here, see, the current tax rate is 20%. The current tax rate is 20%. So your tax position would be 10 million up. Temporary difference into 20% is 2 million. 2 million is your deferred tax liability. Deferred tax liability. 2 million is a deferred tax liability. Okay. Hopefully, you all know how to calculate deferred tax liability. Hopefully you all are able to differentiate what is a deferred tax liability or deferred tax asset, right? I'll only just tell you all. I mean, you all have done F7, right? You all have done F7, so I don't think I need to explain how to calculate deferred tax liability. Okay. So this is it. This is it. You see, due to the upward adjustment, we need to do tax adjustment, right? Why? Because the temporary difference arises. Okay. How does the temporary difference arises? Carrying value, this particular person carrying value is greater than tax base, right? Because of him, I would have to incur a deferred tax liability. This is all I need to include. This is all I need to include. After that, I'll go and speak about my upward adjustment. I will go and speak about my upward adjustment. Okay. I will go and speak about my upward adjustment of my finished goods. Right. And after that, I will speak about the tax impact. Right. Tax impact, how? Let me show you how that arises. 47 million would have been, sorry. 47 million would have, sorry. 47 million would have been my upward adjustment, right, or fair value adjustment that needs to be multiplied at 20% tax rate, right? You all will be getting a tax impact of 9.4 million. You all will be getting a tax impact of 9.4 million. Obviously, that also you all need to show as DTL. You all need to show as DTL, guys. You all need to show as DTL, right? You all need to show this as DTL. Okay, here is the double entry for the people who wants the double entry. For the people who wants the double entry, okay, how does this tax deferred tax liability affects the goodwill? Goodwill will debit and DTL will credit, because DT, obviously deferred tax liability is a liability component, right? And the debit would be transferred to your goodwill. right? And finally, we are left off with this. Here it is, right? There is an internally generated database, right? There is an internally generated database. Obviously, for most of you all know, according to IAS 38, internally generated database cannot be bought into individual financial statements. Why? Why? The reason is quite simple, guys. Because individual financial statements, it's hard to reveal, or it's hard to find out the fair value. It's hard to find out the fair value. So what we do, we don't show them in the individual financial statements. But when y'all are doing group accounts, when y'all are having control, when y'all buy another company, y'all will have rights, right? Then y'all can show this as an asset. Y'all can show them as an identifiable asset. That is what is mentioning in this particular paragraph. That is what is mentioned in this particular paragraph, right? Okay. Although there were no contractual or legal rights, okay, the professional expert has estimated that competitors of Greenco, right, are prepared to pay 5 million. Okay. So this is about IAS 38, guys. It's about IAS 38. It is about IAS 38. What does it say? What does it say? IAS 38. And if I need to consider it as an intangible asset, it has to be identifiable. Identifiable asset. How do you gain identifiability? Either it can be sold separately, or or you can get rights from legal or contractual. Right? If you all mention this, guys, if you all mention this, you all be able to get your marks. Right? You all can speak about IS 38. You all can speak about how does identifiable asset. If it needs to be an identifiable asset, it needs to meet two criteria. One one criteria, it can be sold separately, right? We have proof here. We have proof here. Here, see, competitors are willing to pay 5 million. So therefore, fair value can be valued. Fair value is measured reliably, right? Fair value is measured reliably. That point you all can include. Also, you all can say, even though there is no contractual or legal rights, right? Even though there is no contractual or legal rights, they can be sold separately. They can be sold separately. Therefore, this meets identifiable asset criteria. This meets IAS 38. This meets IAS 38. Right? If you all speak about that, if you all speak about that, and if you all can speak about the 5 million recognition, guys. If you all can speak about the 5 million upward recognition. Why? Why this is an upward recognition? It was not included in your individual financial statements, but this will be included in your group, because now we are able to determine the fair value. Why? A competitor is willing to be, competitor wants to buy that database for 5 million. So the fair value can be reliably measured. Intangible asset says, if you need to categorize as intangible asset, it has to be identifiable, cost must be reliably measured, it needs to give probable economic cash flows, right? Okay, that is it. That is it. Okay, the tax impact would be 1 million. Okay, the tax impact would be 1 million. How did I come up with that? How did I come up with that? 5 million was my temporary difference, right? At 20%, right, would give me 1 million. Would give me 1 million. This how I came, right? This how I came. Yes. Carrying value would have been 5 million for internally generated data. Right? 5 million would have been the carrying value, guys. Tax base would have been remaining constant. So the temporary difference would have been 5 million, right? So how do I calculate the deferred tax liability? 5 million at 20% would give me the deferred tax liability, right? This of course, guys, this of course, this simple F7, this simply F7. If you all know, you all are able to do it, right? I did not bring any standards that is related to SBR in this particular question. That is why I rushed it. That is why I rushed it. Okay, because you all are able to do this. You all don't need my support at all. You all are able to do this. if you all have done F7, right? Okay. Before I move on to the pre-populated sheet, guys, I want you all to give a summary. Right? In this, what did we use? We used IAS 28, right? We used IFRS 10, right? We bought in IFRS 13. We bought in IAS 12. We bought in IAS 38. Who else did we bring in? We bought in, yeah. These are all the standards that you all need to know. These are all the standards that you all need to know. Associate, control, fair value, tax, intangible. These all you all need to know. These are the standards that you all need to know, guys. You all need to attempt this question, right? Normally I do this. Once I'm closer to completion, what I would do is if it's a consolidated question, I would give a summary of the standards. Well, this is the summary of the standards, right? Standard summary, right? If you all need to do this particular question, you all need to know these standards, okay? Now we are finally left off with something called the pre-populated sheet. We are left off with something called the pre-populated sheet. Okay. We are left off with something called the pre-populated sheet. Okay. We are left off with something called the pre-populated sheet. Well, this is a simple copy paste, guys. This is a simple copy paste of this. Here it is. It's a simple copy paste of this draft, right? Now, normally it is advisable, right? It is advisable for y'all to go and do pre-populated sheets on your ACCA practice platform, right? I am 100% telling y'all, make sure that y'all practice all these. Y'all write your answers, y'all do the adjustments, right? Adjustments of pre-populated sheets on your ACCA practice platform, right? Don't do it on Excels, don't do it on Words, because those are not the formats, right? You all need to get yourselves adapted. You all need to get yourselves adapted. Okay, but the reason why am I using Excel is because I find Excel more simple than that ACCA practice platform, guys. Because that's what you call practice platform. Sometimes it does not work properly. It's very hard to move here and there, right? For y'all, I highly recommend go and use ACCA practice platform because y'all are the people who are going to do the exams. Okay. Okay. Now we need to go and adjust. Now we simply need to go and adjust. Before that, I'll go and read the requirement. 7:30. 7:30. I'll try to finish this off within 30 minutes. Right? Hopefully, I'll try to finish off in 30 minutes. They want me to adjust the pre-populated sheet. Okay, fine. No problem. Right? Using my exhibit 3, right, and my previous answers. What do I need to include? Accounting of associate, changing classification from associate to subsidiary, fair value adjustments, and the goodwill using proportionate share net asset method. Right? Now here see, goodwill is valued at proportionate share net asset method. If you do all these adjustments, you will be able to get 12 marks. Right? You will be able to get 12 marks. Okay. Now, I'll give you all 2 minutes, guys. I'll give you all 2 minutes. What I want y'all to do is, what I want y'all to do is, go through this statement. Go through this draft consolidated statement. Go through this. Just simply go through this. Okay. Give me 2 minutes. I'll give you a 2-minute break. Go through this. Hopefully, you all were able to go through this, right? Hopefully, you all were able to go through this, right? So now comes the best part, right? Now comes the best part for the people who like calculations. The people who like calculations, right? First of all, I want y'all to see. Can you see here? Rather than showing these rather than showing these two together, okay, rather than showing these two together, they have gone and showed investment in associate after further investment in associate. What does this mean? What does this mean? When I'm a shareholder, I would of course definitely, be puzzled. I don't know what does this mean, right? This is a wrong way of presentation, right? This is simply a wrong way of presentation, right? This is a wrong way of presentation. So what I need to do is I need to remove, I need to remove this 66 million. All right, you all need to remove this 66 million. Why? This is a wrong way of presentation, guys. This is a wrong way of presenting. Look at this. It's ideally supposed to be under the heading of investment in associate, right? You all cannot show like this. This is not IAS 1, right? IAS 1 says that you all need to present it properly so that shareholders don't get confused. This is simply a confusion, right? That is why it is in draft. Okay. So our first adjustment would be you all need to remove, this further investment in associate, right? You all will be removing it. Okay, you all will be removing it. And can you all see here? Here it is. I told you, see, it is a wrong presentation, right? And always this advisable, this advisable. 1 minute. Always make sure that you all are able to categorize your adjustments in a what you call horizontal manner, right? So that during exams it won't get confused, right? You know what is related, I mean, which are related to which adjustments, right? Now see, number one is related to this further investment, right? This is an error. This is a wrong presentation error. Another one here, see, green goes in equity. You all know, according to group consolidation, you only can bring parents equity. You cannot bring a subsidiary equity. So you all need to remove that as well. Wrong accounting, right? You all need to remove that as well. Wrong accounting. So working number two, we don't show subsidiaries equity, right? I mean, this you all don't need to justify. I mean, you all don't need to tell what is adjustment number one, what is adjustment number six. No, right? This I purposely put it so that you all are able to read it, right? Only for your reference, only students' reference, right? Student reference only. Okay, nothing else, nothing else. Okay. So now we're done with this. We're done with this. Can you all remember? Can you all remember? Can you all remember? Now the examiner wants us to use all four requirements, right? He wants us to use all four requirements. Okay, he wants us to use all four requirements. Hopefully I'll remember this calculation, investment in associate. Hopefully I'll remember this calculation, investment in associate. Can you all remember? Examiner has only done the calculation for $100. He forgot to put 18.6. Can you all remember? He forgot to put 18.6. Okay. So we need to make sure, right? Since this is understated, we need to make sure that this is bought at its current price, right? So you can simply link it up. You can simply link it up. Now can you all see? Now can you all see? 100 plus 18.6 would give you all 118.6. Examiner what he did. He only went and recorded at cost. He forgot to include the share of net assets. That is why I bought this. That is why I bought this. Okay. That is why I bought this. So we are done with 3 adjustments as of now. We are done with 3 adjustments. Okay. Now you all know. Now this is what we call, this is SOFP, right? This is SOFP. You all know it uses double entry. You all know it uses double entry. Okay. Okay. So what you all need to do is, when you all are increasing the investment, or when you all are giving share of profits, right? When you all are giving share of profits, right? Debit investment in associate. Why am I debiting investment in associate? Because I'm increasing it, right? It was 100. It is ideally supposed to be at 118.6. So that's what I'm debiting. And since it's profit, right? I need to translate to retained earnings. I need to translate to retained earnings. Why? It is a profit component, right? It is a profit component. Okay, it is a profit component. Hopefully, all are with me. Hopefully, all are with me. Again, I'm repeating what examiner did. He has gone and done. He has gone and only recorded it at $100. The investment is supposed to be at 118.6. So what I did, I went and increased the value by only 18.6. Why? Before after you add 100 plus 18.6, you will be getting 118.6. That is the first double entry. Okay. The second one is, if this is the debit entry, if this is the debit entry of assets, there should be a credit entry, right? There should be a credit entry in either equity or liability. Where would this go? Where would this go? Right? Where would this go? Since this is share of net assets or share of profits, right? This share of profits will affect my retained earnings. That is what I have done here. That is what I have done here. That is what I have done here. All right. Can now see here, I'm moving according to a pattern, right? I'm moving according to a pattern. Now I finished. Now I finished whatever the calculation that is related to my very first exhibit, right? Now moving to my second. Now moving to my second. I'm going to see, did I do any calculations? Did I do any calculations? No, right? Then I'll go to my third one. Okay, I'll go to my third slide. Before I go to my third slide, do you all remember? Do you all remember there was a step up acquisition? Step up acquisition. Does anyone remember there was a step up acquisition? Right? Because of the step up acquisition, you all need to find profit or loss. You all need to find profit or loss. Well, here it is. Well, here it is. Here it is. You all need to find something as gain or loss. Why do you all need to find gain or loss? You all were at 48%. Sorry, you all were at 48%. You all are moving to 60%. That is why you all can do consolidation. So when you all are moving, right, you all need to do step up acquisition. You all need to sell off your initial investment in associate, and then only you all need to translate to subsidiary. Right? You all need to sell off your initial investment in non-control, and then you all are moving to control. Right? Remember the big car small car example. Okay. Now for that, where would I go and find the fair value? Where would I go and find the fair value? Where would I go and find the fair value? Uh, Here it is. Here it is. The equity of Greenco has, sorry, the fair value of original 30% equity interest was 127, right? Examiner has already given us the fair value. How much is it? 127. Simply copy paste, right? On 1st April 2006, examiner has already given the fair value of 30%, right? Examiner has given the fair value of 30%, right? We have also calculated the carrying value of the 30% investment. How much was it? How much was the carrying value of 30% investment? It was 118.6. It was 118.6. So the difference, so the difference is to be transferred, or the gain on your disposal of investment in an associate is 8.4 million. Is 8.4 million, right? This is the gain in associate. So how this will affect, how this will affect P&L will be 8.4, right? You all need to remove investment in an associate. Why? Because you're selling it off, right? When you're a disposal asset, it will be credit. How much? 118.6. Okay. The remaining will be transferred to my goodwill. The remaining will be transferred to my goodwill, right? So now this entry, these three entries, I need to adjust here on my pre-populated sheet. These three entries I need to adjust. Have you all now have you all understood first until here? Until the third adjustment, were you all able to understand? I just only need to confirm that. Okay, was I too fast? Okay. Okay. So some say that you all have understood first two requirements. Okay. Third is also shape. Okay. You want me to explain fourth one? Okay. Fine. Okay. Can do. Can do. No issues. So what happens is, do you all remember that there was a step up acquisition? You all were initially 30, after it you all bought in 18%, right? That step up acquisition is called as small car, big car example. You all are moving from no control to control, right? When that happens, what do you all need to do? What do you all need to do? You all need to calculate gain or loss, right? Why do you calculate gain or loss? Because you all need to consider you all are selling the initial investment and repurchasing it back, right? That is why you all need to do, or you all need to show gain or loss, because there was no control to control, right? This is why you all need to do something called as gain or loss. How do you do? It's the difference between the fair value of the investment in associate, or the 30%, and the carrying value of 30%, right? Okay. So the fair value is automatically given by the examiner in any question, right? Here it is. The fair value of the 30% investment was 127 million, right? At the date of acquisition. Can you see here? At the date of acquisition. This is the date when you all again repurchase the 18%. First April 2006 was the date that you all repurchased the 18%. That is why I automatically just simply copy pasted it 127, right? This carrying value, I bought it. Can you all remember I did a very first calculation of carrying value of investment? What I did was I simply copy pasted it. Okay, I simply copy pasted it. Right. For you want, I can mention it here. It is simply cost, initial cost plus share of net asset. Right. That's how I was able to derive. Right. I did not go and recalculate it because already this has been calculated. Why would I waste time? I just simply linked it. Right. Are you clear until now? Are you clear until now? Okay, right? You're sure, no? Okay. So the difference between these two, it's either supposed to be a gain or a loss, right? In this point, it is a gain. That gain is transferred to P&L. That is it. That is it. That gain is transferred to P&L, right? That gain is transferred to P&L. Since you're selling off that associate, since you're disposing of that asset, right? You all need to credit that asset. You all need to credit that asset. Here it is. You all need to credit that asset. How much will you credit? 118.6. So minus 118.6, right? This is your first entry. Okay, we are left off with another two entries. We are left off with another two entries. First, I'm disposing, right? After that, I'm having a gain, right? 8.4 million. That gain will be recorded in my retained earnings, P&L. How much? Plus 8.4 million, right? That is also done. Now I'm left off with my goodwill, right? I'm left off with my goodwill, right? I'm left off with my goodwill. Okay. Now let me come to your goodwill calculation. Now let me come to your goodwill calculation. Let me come to your goodwill calculation. Okay. You all bought 30%, right? How much is the fair value? Here it is. Here it is. Here it is. 127 million is the fair value of the initial 30% investment. Okay. Of the initial 30% investment is 127 million, right? How much is the fair value of 18%? I guess they gave it, right? I guess they gave it. You see, you all bought it for 66 million, the 18%, right? You all have bought it for 66 million. Have they given us the fair value of NCI? Have they given up the fair value of NCI in this particular paragraph? Right? Or any other paragraph that we referred until now? Have they given us the fair value? No, right? Why? Because see, examiner wants us to do it. Examiner wants us to calculate the NCI, right? Using the share of net asset. Using the share of net asset. Okay, so I need to first finish off this net asset calculation, and after that only I need to find out fair value of NCI. Okay, so let me move on to this. Let me move on to this. Let me move on to this. Right? You all know how goodwill is calculated, right? You all know how goodwill is calculated. So you all can help me out. You all can help me out. How much was the carrying value, guys? How much is the carrying value for the net assets that is given? According to the question, here it is. It is 348 million. I simply copy and paste this. 348. I simply copy and paste it. Can you all remember we did these adjustments, right? There was an upward adjustment. These will affect my net assets. These will affect my net assets, right? The land upward adjustment would affect my net asset. How much was the land's upward adjustment? How much was my land's upward adjustment? It was 10 million, right? Simply copy and paste it. Simply copy and paste it. The double entry would be, the double entry of this would be debit land, right? And credit goodwill, right? Credit goodwill. How do you all think the goodwill will reduce? How do you all think the goodwill will reduce? Can you all see here? This 10 million, I am going and including it under my net assets. When I include it under my net assets will increase, right? When the net assets increase and when it is more than my total consideration, obviously your goodwill will reduce, right? I have mentioned this in a previous video as well. I cannot remember exactly which one, right? You all can try it out. When you all increase your net assets, your goodwill will reduce, right? Try it out. Try it out. You all will be able to identify. Okay. Okay. So debit land 10 million, right? So I need to go and show that also. Here it is. Land is under your PP. How much is it? Let me leave that as well. It's a 10 million adjustment. Okay. That's a 10 million adjustment. That would increase my land. Okay. After that, there was an upward adjustment for inventory. How much was the inventory upward adjustment? How much was the inventory upward adjustment? It was 47 million, right? So how that also would be? That would be debit inventory, right? Credit goodwill. That's the double entry for that. That is the double entry for that. Okay. So I need to go and increase the inventory as well. Where would inventory be? Current assets? Here it is. Here it is. How much did that increase? That increased by 47 million. Okay. That increased by 47 million. Okay. I'll go and increase that as well. Okay. And after we were able to identify an intangible asset, right? Which was not record the database, which was not recorded in its individual statements. That is how much? That was about 5 million. That was about 5 million, sorry. Right? This 5 million will come under current assets. Sorry, intangible, no? Intangible net assets are your, yeah. Okay. Intangible asset of 5 million. So I will be bringing this also in. Okay. So that is it. That is it. We are almost nearing completion. We are almost nearing completion. We have bought all of this, right? We have bought all of this, right? Intangible, where would I show? Yeah, intangible would be in non-current asset only. Yeah, it has to be there. Okay. Do you all remember the detailed calculation? Do you all remember we individually calculated for all of these people? We individually calculated for all of these people. Let us sum it up. Let us sum it up. How much was it? How much was it? For 10 million, it was 2, right? Or wait, I'll bring the calculation, right? I would say this into 20%, right? Plus this into 20%, right? Plus we are left off with intangible, this one into 20%, right? We are left off with. Can you see here? This entire one, 12.4 is a decrease, right? Because by DTL would debit my goodwill, right? And it would credit deferred tax liability. It would credit deferred tax liability. Okay. How does my goodwill increase? How does my goodwill increase? When you reduce your net assets, can you see net asset is reducing? When you reduce your net assets, guys, when you're reducing your net assets, obviously your goodwill will increase. Okay. So let me go and show deferred tax liability. Deferred tax liability. Deferred tax liability should be here. 12.4 million. 12.4 million. Right? It's my deferred tax liability. Okay. Now I'm left off with only calculating NCI. I'm left off with only calculating NCI. I just need to find out how much is my net assets. I need to find out how much is my net assets. Right? This would be my net assets, right? 397.6. 397.6. So out of this 397.6, how much would be the net asset? How much would be the NCI's value, guys? NCI's value would be 52%, I guess. Right? Because you only own 48%, right? NCI owns 52%, right? So you need to give him $206, right? So the total consideration would be, how much would be a total consideration? How much would be a total consideration? 399, right? From that, you minus off your net assets. It would give you goodwill of 2 million. Goodwill of 2 million. Wait, I need to check. I need to check whether is this correct or not. Let me check with the answer scheme. Yeah, correct. 2.2 million. We did not get 2.2. Rounding off, no problem. 2.152, no problem. 397. Yeah, and 399. Okay. Yeah, this is it, guys. This is it. This is it. 2.152, you'll be going and recording under Goodwill. Right, guys, Goodwill. Here it is. Right? Goodwill, here it is. 2.152, you'll be going and recording under Goodwill. Right? You'll be recording him under Goodwill. Also, have we forgotten anything? Okay, here, NCI. 206. You have to give NCI, right? Fair value of NCI. Fair value of NCI. 206.752. Okay. I guess this is it. I guess this is, we can now we can close the entries. I guess we can close the entries, but before that, let me go and see. Let me go and see. Okay. 66 was mentioned. 348 is also mentioned. 18.6. Yeah, okay. The profits is also mentioned. 118.6 is working number 3. Okay, that is also mentioned. Okay, one entry.